It is ideal to accumulate wealth during a recession. The current situation appears to be a once-in-a-lifetime opportunity to substantially increase one's wealth. In anticipation of a recession, all chief financial officers are cutting costs by 10%. JP Morgan has warned that the stock market could fall another 20% from its current levels. During a recession, unemployment rises while wages fall. Almost every market component, stocks, energy, food, and services, experiences a price drop, resulting in a drop in consumer confidence. Second, recent quarterly earnings growth has been slow or negative, which can be attributed to the impact of recessions on corporate profits. Earnings compression and job losses exacerbate the problem and precipitate mass layoffs. As a result, aggregate demand has fallen dramatically, and it is clear that dozens upon dozens of businesses have laid off workers. According to Bank of America, the United States will lose 175,000 jobs per month. What does this mean for your investment? And how can you take advantage of this information? Let's begin with real estate. True, each area is different, and some areas may continue to have thriving housing. National declines, on the other hand, are uncommon. Only a few times in the last 60 years have prices fallen by more than 10%. The consensus on Wall Street is that national housing prices will fall by 7%, with the worst drops ranging from 10% to 15%. If interest rates continue to rise, each market will react differently. Parts of Idaho, Florida, Arizona, and Southern California, among the most vulnerable markets, could see a 25% drop from their peaks. This drop typically lasts about a year and a half before ending. Those with fixed-rate mortgages who plan to stay in their homes for at least the next 5 to 10 years will see little change. The second consideration is money. According to popular belief, cash serves no purpose other than to rot due to inflation. Cash, on the other hand, may be the most secure place to keep one's money when asset prices are falling. Without a doubt, cash is becoming an essential component of any successful investment strategy. In comparison to 2001, fund managers now have the highest cash balances. Similarly, Citigroup stated that investors only have cash as a way out of recession. Stocks are the third category. According to JP Morgan's analyses, all three major indices have dropped up to 30% this year and are expected to drop another 20% from where they are now. Looking back to 1946, the maximum bearish value was 30%. The worst fall was in 2009, when the S&P dropped 57 points from its peak. When the average and the recession are combined, these bear markets dropped to a very low level of 34.8% on average, with the current market decline being around 25%. When everyone stops investing, things usually start to improve and people can begin to feel optimistic again. How do you make this a profitable situation? The information that follows is essential for you to have. The first way a recession can be a once-in-a-lifetime opportunity to get rich is that everything will be cheaper. A wealthy individual would see this as a chance to save 30% on everything. Warren Buffett has provided an excellent analogy of this, stating that when prices for items such as hamburgers fall, people rejoice, and when prices rise, they cry. When the value of stocks falls, investors can get more for their money. The issue is that they are no longer widely used. The recession, on the other hand, is the market's way of weeding out the weak and allowing smaller businesses and individuals to develop. The peak of any market is analogous to a building. with only the highest receiving sunlight. As in our markets, this means that only established companies have access to resources. However, our economies, like a burning building, have a way of bankrupting the giants that can no longer sustain themselves and allowing smaller businesses to thrive and develop. The third point to make is that each bear market is followed by a bull market. During recessions, the S&P 500 has fallen to an average of 29 points, according to Yahoo. However, the stock that had fallen to its lowest point returned 40% the following year and 58% after a few years. This implies that investing during a downturn is more profitable than selling during a boom. Long-term markets have consistently recovered throughout history. The fourth prerequisite is that you act before anyone else. It's easier said than done. Investing during recessions appears safe, but recessions are never confirmed. The Great Recession of 2007 was, for example, not officially declared until December of 2008. We always find the recession just as it is about to end. Fifth, during difficult times, businesses cut back on expenses to save money and play safe. On the other hand, it enables smaller, more aggressive companies to take their place. According to one study, those companies that continued to advertise increased their wealth and grew with positive growth after the recession ended. What choices do we have? To begin with, you should only invest for the long term. In general, do not invest any money that you will need in the next 5 years. The best way to invest is to do nothing different than you always do. As seen and observed, dollar cost averaging or buying at irregular intervals is one of the most profitable investment strategies. As a result, stay in the market and continue to buy. Second, you should protect your career. Regardless of what happens, this will serve as your best insurance policy. The worst case scenario is that the market falls and you lose your job at the same time, with the investment selling off before it has a chance to recover. This is an excellent time to learn new skills and improve on those you already have. A 5% allocation to Bitcoin, for example, could have increased a portfolio's return by 65% since 2014. Third, broaden your investment portfolio. If you can't handle a 20% price drop, you've probably invested too aggressively. If you've done well in US tech stocks, for example, you should consider investing in real estate, where rents appear to be more stable. As a result, your portfolio will be more stable and unlikely to crash. Keep an eye on your market. Fourth, cut unnecessary costs and run a lean operation. Continue to reinvest in the market as much as possible. Prepare a backup plan for what you'll do if your investment drops by 20% to 50%, how you'll make up the difference, and whether you can potentially take preventative measures ahead of time. Fifth, always keep some cash on hand. One must be convinced that investing money is the best way to spend money. When one has cash on hand, one must be at ease. Depending on the season, an investor should keep 15 to 20% of his or her portfolio in cash. This enables investors to take advantage of good opportunities. Please give us a thumbs up if you enjoyed our content, and we'll see you again soon with another video.